Welcome to the InvestSense Market Summary for the fourth week of August 2025. And we've seen a little bit of volatility creep back into markets, both in terms of equity markets and also in bond markets as well. Although credit spreads have remained relatively well behaved. And actually, one of the interesting things about the chart in front of you is it's the Nasdaq that's been on the back foot a little bit of volatility, down a few percent at the beginning of the month, crept its way back up, and then gave back a few percent again last week before bouncing back again. And you can see below also 10-year bond yields jumping kind of all over the place. Now, okay, this is only 20 basis points, 0.2%, doesn't sound like a lot, but we're not back in the early 1980s. In this day and age, these are reasonably big moves, and we'll get into why that is. But also, first of all, back to the US economy. One of the biggest things last week was the Walmart earnings guidance, forward-looking, a little bit dismal. Also, signs of tariff impacts, for instance, in the Japan trade data, automobiles on the back foot. I mean, all of that stuff is kind of looking backwards, but there are a few chickens coming home to roost in terms of economic activity. But if you look at that chart, the grey line, which is global small companies ex-US, and the dotted white line, which is the Russell 2000, up 6% so far in August. Now, that's a little bit reminiscent of some of the comments we're hearing from fund managers and people around the traps, that the animal spirits in the US, in the real economy, and also the financial economy as far as fund managers are concerned and their outlook, is that actually the animal spirits are awakening a little bit. Maybe that's corroborating it. But you've had a little bit of a divergence between those smaller companies, also emerging markets doing very well. Chinese equities up 5% or so over the past week. Some of the reforms around where people can work and live and buy houses being treated very positively, and maybe that's been seen as an indication that the powers that be in China are being a little bit more open-minded about the market economy. Now, back to those tech stocks and that volatility there. I mean, look, they are quite expensive. There's a lot of uncertainty, and that's probably why they're going to be moving around more than other areas of the market. But in particular, last week, it was this report that came out from an MIT researcher that showed that 95%, now remember this is big companies, 95% of large companies in the US were not making any money out of AI. And it also went into some detail into the nature of pilot projects that didn't go anywhere. It was a little bit dismal reading. So on the one hand, you've got all this AI spend in data centers and chips, etc., especially driven by the Mag 7. And on the other hand, you've got this sort of thought bubble that we've been here before. Maybe is this a little bit .com? Yes, these companies have got a lot of cash flow, but at the same time, could they be piling similar amounts of money, even more, into something that it's going to take a long time to monetize, as we saw with .com? So the jury's out on that, and things are moving around. But also, it's probably something to do with interest rates. And again, given the long duration cash flows of those companies and the fact that they're relatively expensive. And that's where we've seen a lot of the movement. Now, you can see here, this is looking at the yield curve in a sort of cross-sectional way, if you like. And really what it's showing is that white line, which is sort of 1 year out, where interest rates are expected to be. That's what that's really driven by. And then 5 years, 2 years, and right up at the top there, you can see a little bit less volatility, but it's still being moved around by these short-term movements, which is telling you the market is saying there's a little bit of dependency, contingency about what happens now that might affect the future. So we're seeing a little bit of volatility there, but of course that includes the term premium, which is the risk that you take on just for holding longer-term debt. This other measure, the option implied spreads, OIS spreads for Australia and the US, sort of takes that out, and you can see that there's a pretty clear picture that US rates are expected to come down by a greater amount because they started off much higher. Remember, the RBA didn't have the same flexibility given our variable mortgages predominantly in Australia, but US rates are expected to stay down a little bit more. Australian rates move down a little bit and then perhaps move up by more. But at the end of the day, the differences aren't huge. And what we're looking at is, a percent and a half in the US, maybe 0.5% over the next year or so coming down in Australia. Not a huge amount, and probably that's not representative of a very deep recession. And hey, the markets don't always get it right, but that's what they're forecasting at the moment. Now, Something that we talked about in the last few weeks is a conversation we've been having with Andrew Hunt about the contingency and the fact that we're on this knife-edge equilibrium between more inflationary conditions given deficit spending, etc. And on the other hand, maybe markets freezing up a little bit if they balk at actually lending a lot of the money that's needed to fund those deficits, the big beautiful bill, etc., and whether the commercial banks play the game or not. And that's something that we expect to be able to report a little bit more on in conjunction with Andrew over the next few weeks. But for now, perhaps some of that bond market volatility is alluding to the kind of decision, the knife-edge equilibrium that Andrew's been talking about. Now, I'm not going to steal the thunder of our head of Australian equities, Tim Binstead. We're a large part of the way through the Australian reporting season. It has been quite eventful, hasn't been terribly positive. Normally you get more beats than misses. We've had a little bit the opposite. And over the past week, you can see there's been a little bit of volatility at a company level. So we're going to go into that in a little bit more detail with Tim in another part of the newsletter this week. And we're not going to call it the final wrap up because we're not quite there yet, but a lot to discuss. Look forward to talking next week. Thanks.